In chapter 3, we talked about the financial analysis. So, these two chapters, again, as I mentioned before, involve a lot of accounting, but we are making progress towards our goal of doing actual financial, corporate finance subject. Okay? All right, so financial planning involves two different types of planning. One is strategic planning. The other is operational planning. But operational planning is actually part of strategic planning. Okay? And strategic planning involves more of long-term changes and also structural changes. Okay. If you've taken principles of economics, you probably learned that this concept of there are three different types of unemployment: cyclical unemployment, structural unemployment, and frictional unemployment, something like that, right? So just like that definition, the structural changes imply some significant changes in the structure of the economy. Okay? What are the examples of structural changes? Well, again, it deals with the long-term changes. Okay? So not only some minor adjustments or fluctuations in economy, ups and downs in the economic activities. We're talking about something fundamental is changing. Okay? If you read the chapter uses the onslaught of internet and e-commerce as a good example of structural change. Okay? Until about 20 years ago, internet, I think there was internet about 1994. Yeah, there was internet, but very few people were on the internet. Okay? And it was just the beginning of the development of internet and World Wide Web. Okay? So the e-commerce, the idea of e-commerce was not really popular or widespread at that time. Okay? So there's some companies like Barnes & Noble or Borders. Barnes & Noble and Borders both were two of the largest bookstores in the United States. Okay? But they didn't really catch on to the idea of selling books on the internet until pretty late. Okay? So unfortunately, Borders had to close. You know what happened in the bookstore business on the internet, right? Amazon.com came around, okay? And then there were lots of other businesses emulating the Amazon.com business model and started selling books on the internet to wider audience. Okay? So the sales of Borders and Barnes & Noble went down significantly. Okay? All right. And eventually they had to close a few years ago. I think Barnes & Noble still is around, but their business is significantly impacted by the presence of other online booksellers. Okay? I can use another example of fuel economy. Okay? When I first came to the United States in 1982, I noticed that the U.S. auto industry was having serious trouble. Okay? During most of the 1980s and 1990s, Japanese cars were very popular in the United States. Okay? And the U.S. auto industries were about to go out of business, quite frankly, around 1980. Okay? And after 1990, starting from 2000, there was a significant comeback of the U.S. auto industries. Okay? But during about 20 years of period of 1980s and 90s, there was a serious downturn in U.S. auto industry. Okay? Does anybody know the reason for that? Why was Japanese automobile so popular over the U.S. automobile? What started this? Any guess? Price? Maybe in the beginning, but when Japanese cars became popular, the car price went up quickly, right? Became quite comparable or even more expensive than U.S. cars. Okay? But what made the Japanese cars so popular over U.S. cars? American.
Because of exchange rate.
Exchange rate? Well, I guess you guys are too young to know about this. There were a couple of big incidents in 1970s, more exactly 1974 and 1979. Does anybody know what happened? Oil shocks. That's right, oil shocks. Yeah. There were a couple of disruption of oil supply. Started with some political situation in the Middle East. There was conflict between Iran and the United States, and the U.S. naval force blocked Hormuz Strait. Hormuz Strait is a very narrow strip of ocean near Iran. And all the oil exports coming out of Iran had to come through Hormuz Strait. But the U.S. naval force completely blocked. And so the oil price went up significantly. And when the oil price goes up, gasoline price also went up. And that put the entire world in big trouble. What happened in Korea in 1979? If you ever heard of it. The most significant incident in 1979 related to current President Park Geun-hye. Huh? Her father, former President Park, was assassinated in 1979, October of 1979. I was at your age. I was a sophomore in college. And one morning, my father, in October, I was president of a drama club. And we were having the performance, a 3-day performance. We practiced hard. And we finished one day, and it was Friday, as I remember, right? So Thursday, Friday, Saturday performance. Friday morning, my father came to me and told me that the President Park was killed, assassinated, and all the college campuses were shut down. So no more performance. So that's a long story, but in my opinion, that assassination was prompted by this oil shock. Really, because of the oil shock, Korean economy went down. So most of the 60s and 70s, the Korean economy has grown so fast, double-digit growth rate every year, like 12% growth rate, right? Or sometimes 15% growth rate. Right now, China is growing fast, but I think the Chinese economy has been growing 8%, 9% annual rate. But at that time, the Korean economy grew at 12%, 15% growth rate, right? Amazing feat. And then in 1979, the growth rate was negative 0.5%. The Korean growth, the economy was completely stalled. It hit the wall because of this oil shock. Korea doesn't produce any single drop of oil. We are 100% dependent on foreign oil. So when the oil supply was disrupted, it just completely stalled most of the industries. And a lot of businesses, a lot of jobs went down. It had to declare bankruptcy. Okay? And that changed the whole thing. That changed the politics. I think I mentioned it. And I was a student of political science, the politics and diplomacy at that time, right? But throughout these periods, I noticed that what changes life is economy, not the politics. Okay? Thousands of people got killed protesting against the dictatorship of President Park at that time, okay? But nothing changed. But when the economy went down, boy, that's this 19-year president was assassinated one night by his right-hand man. Do you know who killed him? Yeah, who was the chief of Korean CIA, right? So president's right-hand man just killed him. I mean, shot him dead at the party, right? All right, anyway, so that's what happened during the 70s, right? So suddenly, even in the United States, the oil price and the gasoline price went up so much, okay? And until that time, basically 95% of all the cars produced in the United States were 8-cylinder, huge cars, okay? If you look at those cars, you could easily put a swimming pool inside the car. Pretty, well, at least a bathtub. Pretty big bathtub, right? It's called the gas guzzler. It uses so much gas, right? So suddenly, it became very expensive to drive these huge cars. But at that time, the Japanese automobile, the Honda 1974 model, if you look at it, it's about this big. Right? I think 2 people can easily lift this car. Right? And I heard that actually that car had a motorcycle engine, right? So it was very extremely gas efficient, right? So, U.S. automobile industry had no idea it was coming, okay? And when the gasoline price went up, it didn't come down for a long time, okay? So for almost 10, 20 years, U.S. automobile industry had to suffer, okay? Because they were not ready to produce small engine, gas-efficient, fuel-efficient cars, okay? So that's another example of structural changes, okay? One thing, something important changes, okay? And something you have to get ready by looking ahead for long term, okay? 10 years, more than 10 years ahead, okay? Operational planning is more of a short term, maybe 1 to 5 year plan, okay? And it involves where the firm wants to be at some future point. Again, maybe 1 to 5 years later from now. Okay? So it is what we call operational objectives. Objectives. That's what we mean by this. Details where the firm wants to be. Okay? So within 1 to 5 years, what do you want to achieve? Okay? Something like, well, maybe we want to achieve the larger market share, increase our market share from 5% to 15% in 1 year or 2 years. Okay? Or maybe bring down our debt. We are borrowing a lot of money. We have a lot of debt. So maybe in 2 years, we want to bring the debt ratio to, 50% of right now, something like that. Right? So it involves something specific goals and objectives. Okay? That's what we mean by operational plan. Okay? So here's a chart out of your textbook, out of your chapter. Okay? And starting from the long-term goal of the firm involving strategic planning, okay? And then we have operational objectives. So based on the objectives, you should come up with some detailed plans. What can we do to achieve these objectives? Okay? And typically, they have 4 categories: marketing plan, production plan, human resource plan, financial plan. Okay? So when you have these plans established and implemented, right, then you should constantly reevaluate, right? So whatever your marketing plan is doing right now, does it help achieve operational objective, right? If our goal is achieving the market share, larger market share in 18 months, right? What we are doing right now in marketing, can it help, right? Can it achieve these operational objectives, okay? So constantly it should be reevaluated, right? And maybe adjusted if you consider the plan is not appropriate, okay? All right. So here's a chart on cash flow analysis. Okay? Remember this chapter is about the cash flow. I think I mentioned it last class. Right? We're going to talk about cash flow statement in a few minutes. Okay? But just a simple understanding of what we mean by cash flow. How does it flow? Right? So let's say we start from here, raising fund. So initially you raise fund. There are 2 different ways to raise cash. Okay? One is external, the other is internal. Okay? So, well, in the beginning, before you started operation, maybe you don't have any money generated from inside, so you have to raise the cash from outside. Okay? And there are 2 types of financing or raising capital. Okay? That is debt financing, equity financing versus debt financing. Okay? Equity financing means you are selling stocks to raise cash. Okay? Debt financing means you are selling what? Bonds, right? Or IOUs, okay? To borrow money. Okay? So there are 2, again, there are 2 types of external financing, debt financing versus equity financing. Oh, yeah, I remember now. Sorry. Before we go on, before I forget, let me talk about this. Okay. I think after last class, she asked me the question about this issue. Okay, because it's important, let me go back here. Okay. Just bear with me just a few minutes. Okay. Here. Here. Okay. All right. So here, we're back to DuPont analysis. So ROE is ROI times equity multiplier. Okay? Equity multiplier, which is nothing but total assets divided by the equity, right? And if you remember last class, I told you that I used the concept of leverage, right? So the more you borrow, it's easier to increase ROE, right? The return on equity can be artificially increased by borrowing more and more, right? And she asked the question after the class that if you keep borrowing, right, then yes, the equity multiplier will increase because you have more debt compared to equity, right? But can it also increase total asset? Because total assets is equal to liability plus equity, right? So while this one grows if you have larger assets on this side, that can possibly offset, right? Can it possibly offset, right? So then I realized that my explanation was not very clear. Okay? So the equity multiplier is a measure of degree of debt financing. Degree of debt financing, right? As opposed to equity financing. Right? So what this is about is while you are purchasing certain amount of asset, right? So let's say this total assets fixed. Okay? The amount of total asset is fixed. So while you are trying to purchase certain amount of assets, are you raising the fund using equity or debt? So we're talking about percentage. Is it 20% equity and 80% debt? Or is it half and half, or the other way around? Okay? So the point of this analysis and point of this equation is you have to assume that the total asset is fixed. Okay? But what's the ratio between the debt and equity? Okay? So if the debt financing, degree of debt financing increases, right? That will increase the equity multiplier, right? And for the same amount of ROI, you will end up with a higher ROE. Okay? So return on equity will increase. Okay? So don't worry about it. I mean, you don't have to worry about that offset scenario. Okay? And the point of this equation is when the degree of debt financing increases. In other words, while you borrow $100, right? While you raise $100 capital or cash, right? Are you raising 20 on equity or 80 on equity, right? Or 20 on debt or 80 on debt, right? So when the company uses more debt financing compared to equity financing, right? Then this will be larger, which will result in larger return on equity. Is it clear? Is it better? Okay. So that's the point of this equation, right? All right, sorry. I keep going back and forth. All right. All right, sorry. All right, so here we go. So let's say you raise certain amount of fund using external financing, right? And then with that money, you either purchase long-term asset, in other words, fixed asset. The fixed asset is the same thing as a long-term asset, right? You know, plants and equipments and facility and so on, right? And some working capital. What is a working capital? Okay, let me... Working capital is the difference between current asset and current liability. Current liability. And that's working capital. So you can say this is, in other words, net liquidity. Liquidity. Right? The concept of working capital is specifically dealt with in something like chapter 15 or 16 of our textbook. Okay? But right now, you can just understand it this way, that working capital is the difference between current asset minus current liability. Okay? What you have immediate access and what you owe in short period of time. Okay? So basically, how much liquidity you have available right now for your disposal, at your disposal. Okay? So working capital is very important for management. If you do not have enough working capital, again, you can have a problem, cash strapped, okay? And you may not be able to pay all the bills, okay? Or you may not be able to purchase all the resources that you need immediately within a short period of time. Okay? So you don't want to have working capital problem. Okay? So basically, the fixed asset versus current asset or net current asset. Okay? So with the money that you raised, you purchase the asset. Using those assets, of course, you produce and sell products or services. Okay? So you pay for the services and inventories, and once you sell the products, you may have some account receivables. Okay? And when the account receivables are collected, you come back with some cash or fund. Okay? And you have two different uses for your cash or fund. Okay? You can either reinvest, it's called the plowback, or retain the earning, right? Or you can distribute part of the money to owners or creditors, okay? So you can retire some debt. In other words, you pay back some debt or pay dividend to stockholders, okay? But whatever is remaining after those things, right, it becomes internal cash raised, internal fund raised, okay? So cash flow from operations, from these operations, right? And sometimes you sell your asset if you don't need any assets anymore, or if you need more fund. Sometimes, you know, especially Korean chaebol corporations have a lot of lands, okay? They're holding a lot of lands, right? And when they need more money, they sell these lands, okay? So that's the idea of sale of assets. Okay? Okay, so then we can start another cycle, right? That's basic analysis or chart of cash flow. Okay? And this is probably redundant. I already emphasized the cash importance of cash flows. Yeah? But since this chapter is about the cash circulation and cash flow, let's just talk about it once again. Right? A lot of key performance measures that we talked about in Chapter 3, right? A lot of those financial ratios are accounting-based. Okay? And accounting-based measures have very significant weakness. Okay? It depends on ability to, the much of the financial health of a firm, okay, in fact, right, depends on the ability to generate amount of cash. No matter how it looks on your books, in your accounting charts, accounting tables, right? If you don't have enough cash, then you can be in big trouble, right? That's the idea. Okay? Performance measures that are not based on cash flows are subject to short-term manipulation by managers. How many of you are accounting majors? I guess not in this school, right? Even though you are, I guess there should be in the School of Business, right? Yeah. Accounting is a very necessary and very useful, indispensable. You have to have accounting knowledge. Without accounting knowledge, you can't run any business. Okay? But the problem with accounting is it can be very creative. Have you ever heard of creative accounting? Okay? Okay? And accounting shouldn't be creative. Okay? Accounting, in your table accounting charts, you should see the facts. Okay? But the thing is, all the incomes, depreciation, we talked about depreciation last class. Okay? Once you purchase an equipment, you don't deduct the cost immediately, right? But you spread the total cost over many years. Okay? And those things leave some room for manipulation. Okay? And if you do cash-based accounting, if you have cash flow chart or cash flow statement, okay, that cannot be creative because it is verifiable. Cash balance is verifiable. How do you verify cash balance? Well, you can count the money in your bank account, or you can count the money in your copper, right? So, you can compare the cash flow statement to the actual amount of money you have, right? But about the income statement, it's very difficult to verify, right? There is actually no way to verify all the figures in the income statement, okay? Actual income statement can be quite complicated, okay? And again, it depends on how you evaluate your equipment, right? Based on the depreciation method you have used in the past and the depreciation method you use right now, okay? And that changes the amount of taxes you owe and so on, right? So, well, since you guys are a little bit bored, let me try to tell you a joke. Right? I'm not good in joke, but let me try. Okay? There are lots of jokes about accountants. Well, there are lots of jokes about economists as well. Okay? But here's one. There was a chairman of the board was trying to hire a new CEO, right? And he invited 3 candidates. And the first candidate has an engineering background. Okay? So this chairman of the board asked this very simple question: what's 2 plus 2? Did you hear about this joke? No? Okay, good. Right? So this guy with engineering background pulls out a slide rule. You know what slide rule is? Those engineering guys use this ruler to calculate things, right? Make some computations, okay? And he says, well, looks like it's going to be somewhere between 3.999 and 4.001, right? And the second candidate is a lawyer. Okay? So this chairman asks the same question: what is 2 plus 2? And the lawyer says, well, according to the cases, there was some case ruling that it is actually 4, but it is debatable. Okay? So this chairman, I guess, shakes his head and calls in the last candidate. Last candidate is, of course, an accountant. Okay? And he asks the same question: what's 2 plus 2? And this accountant stands up, goes to the windows and closes the blind, goes to the door and makes sure the door is locked, right? And comes back to the chairman and whispers, what would you like it to be? Right? The point is, accountants can make any number that you like, right? So in your books, that's called the creative accounting. So you have to realize the benefit of making your decisions based on cash flow statement rather than the accounting-based financial ratios. Okay? Okay. So let me just add one more thing here. About 20 years ago, around 1990s, late 1990s, well, about 15 years ago, I guess, right? There were a few big scandals in the United States. Okay? Enron is a huge, used to be, I don't think it exists now. Okay? It's a huge energy company. Okay? WorldCom is, I think at that time, the biggest telephone company, well, next to AT&T. WorldCom provided the mobile communication. Okay? And these were a couple of examples of this huge scandal. Okay? Basically, the accountants cooked their books, okay, and lied on the accounting books, the statements, okay, and deceived the stockholders, owners, right? And stockholders had no way of knowing, right, whether it is true or not, right? So when this came out, I think both companies had to disappear, right? And a lot of people went to jail, right? A lot of people lost money, right? So this prompted some changes, right? In the United States, early 2000s, there was a new law called the Sarbanes-Oxley Act. They talk about it in chapter 4, right? In this chapter, I believe. Okay. Sarbanes-Oxley Act. These are two people, the last name of two people, two Congress people. I think maybe one of them is senator. Okay. So these two people introduced legislation, new legislation, and became a law. Okay. And this is about the corporate transparency and responsibility. Corporate transparency and responsibility. Okay? So this emphasized that the corporations have a responsibility to protect the interest of owners, stockholders, okay? And they need to show everything clearly, what's happening inside the company. Okay? So the biggest change was about this board of directors. Believe it or not, until early 1990s, right, the directors, ISA, right, directors, right, were not really responsible for any problems. So even when the companies like this Enron and WorldCom were in big trouble, the directors were not. I mean, prior to Enron and WorldCom, right, directors were hardly put in jail. Okay? But starting from this time, I think Enron and WorldCom was the first cases where the directors were put in jail, okay, for this corporate misbehavior. Okay? And after that, they recommend a lot of outside directors, okay? 사회이사, right? And I think I explained it in the first class, or maybe second class. Okay? Even in Korea these days, they recommend a lot of the companies to have a lot of outside directors, right? Especially the nomination committee, the committee which invites more directors, right? Or should be composed entirely of outside directors instead of ingrown directors, right? So that's the result of the Sarbanes-Oxley Act. Okay? In this school, College of Economics and Finance, a few professors are currently holding the position as outside directors in major Korean corporations. Okay? You may hear about it later. Okay. Let's see. ATCF, after-tax cash flow. Okay? So now we are getting into a little more technical stuff. Okay? Well, we need to have clear understanding of ATCF, after-tax cash flow, which is pretty simple. Okay? That is EAT, which is net profit or net income, earnings after tax, okay? Plus non-cash expenses. What that means is, EAT is the bottom line, right? When you have income statement, at the bottom you find that the last line is EAT, right? So from the gross sales, you subtract all kinds of things, and finally you arrive to EAT, right? But the point is, some of these subtractions were not really cash expenses, right? Some of those expenses exist only in the book, right? And the company actually did not spend any money, right? So what that means is the actual cash amount, cash balance the company has is actually bigger than EAT, because some of the expenses were fake, right? It was not cash expense, right? So we have to add it back in order to come up with the after-tax cash flow, actual amount of cash the company has. We have to add back the non-cash expenses, right? What are those non-cash expenses more exactly? Typically, you can think about two items, depreciation and deferred taxes, okay? And of course, depreciation is, non-cash expense because, when you purchase an equipment, you might have made a cash payment in the beginning, in the first year, right? But you cannot deduct the entire cash payment in the first year, yeah? You have to spread the cost over the next 5-year, 7-year, 10-year periods, right? So starting from the second year, third year, fourth year, on the book, income statement, they keep listing, depreciation cost of $200,000, right? But that did not actually happen, right? Okay? Or the company might have purchased this equipment on loan. They might have leased or whatever, right? Purchased by financing, right? Then they make some financial payments, right, over the years, right? So that's the reason why the IRS, or IRS is in Korean 국세청, tax department, tax bureau, right, recommends the deducting the cost over many years, okay? Because many times companies do not pay cash all at once, right? They finance this equipment, right? So, All right, deferred taxes is a non-cash expense because it represents the difference between actual taxes paid and the taxes reported on the income statement. Well, it's hard to understand based on that, but if you look at this chart, let me explain what that means. Hold on. You don't need any heating here, right? You actually need cooling. Okay. All right. So in this statement, the purpose of this statement is to show you the difference between the EAT and ATCF, right? So here, financial reporting purposes. In other words, this is what you're going to see in income statement, okay? Tax purposes, you may have completely different story, okay? The story is, okay, we start with let's say $100 million sales, okay? And then you subtract expenses before depreciation, right? So let's say we have $70 million expenses, right? And then in the income statement, you see $10 million depreciation, okay? And it says straight line here, and MACRS, okay? These are two primary depreciation methods in accounting, okay? Straight line means just a linear depreciation. So if you have 5-year equipment, let's say. Suppose you purchased a computer and paid $100, okay? Then typically computers are considered 5-year equipment by the tax department in accounting, right? So that means you would deduct $100 over the 5 years, right? So every year, next 5 years, you're going to deduct $20 every year, Okay? So according to straight line method, there was $10 million depreciation. Okay? MACRS is, okay, modified, accelerated, MACRS, modified, accelerated, what's that? Cost recovery system. Cost recovery system. Okay, MACRS, right? In accounting, we simply call it accelerated, accelerated depreciation. Okay? So this allows recovery of cost in the early part of asset's life. This allows recovery of costs in the early part of assets life. Okay? So instead of spreading evenly like this, okay, MACRS may allow you to deduct $60 in the first year, $30 in the second year, $10 in the third year, which means next couple of years you cannot deduct anything. Okay? Which one do you prefer between straight line and MACRS? If you're running the business, right? Which one would you prefer? Straight line, because it's easier. Yeah? Hint is, think about time value of money.
Depending on interest rates?
Well, let's say interest rate is just positive. It could be 2%, it could be 20%, right? I think most businesses will prefer accelerated, right? Because you're deducting a larger portion of the cost early enough, in the first year, for example, right? So in the first year, if you go by straight line depreciation, you deduct only 20%, $20 from your profit, right? Which means if the profit was $100, you owe taxes on $80 profit, right? I'm trying to make it very simple, right? Suppose your revenue was $100, right? And if you deduct $20 as a depreciation cost, then you will owe income tax on $80. But in the second case, from the $100 revenue, you subtract $60 as your cost, and you are left with only $40 profit. So your tax liability will be smaller. Okay? Does it make sense? In the early part of your life, right? Well, of course, later, they will even out. It will be 100, it will be 100. The problem is you keep more money this year compared to 4 years later, 5 years later, right? So, remember, $1 today is worth more than $1 tomorrow in finance, right? So if you have more money left right now, you can do lots of things with that money. Okay? So that's why a lot of businesses use MACRS. Okay? Okay? So here, for tax purpose, for financial reporting purposes, so in income statement to their stockholders, they use $10 for straight line method and report $10 as depreciation, right? But in the actual calculating taxes for them, they use MACRS and come up with the $12 depreciation. Okay? So the difference is earnings before taxes is $20 here, but here, when you use MACRS, it's $18, right? So let's say your tax rate is 40%, okay? Income tax rate is 40%. And you owe $8 according to this, according to income statement, right? And the net profit EAT is $12, okay? But in fact, what you paid is based on this MACRS method, right? So you owe only $7,200,000 as taxes, right? So you end up with EAT of $10.8 million. Okay? Okay? So there is a difference of about $800,000 or $0.8 million in taxes, tax liability, right? In other words, in your income statement, you reported that you have paid $800,000 taxes, but in reality, $8 million taxes. In reality, you actually paid only $7.2 million taxes, right? So, So when you try to come up with the ATCF, after-tax cash flow, okay? You can start with the earnings before taxes, right? And what else? Deferred, okay? You have to add back the difference here, okay? Deferred taxes is $800,000, right? Because you can say, well, eventually it will even out after 5 years, right? This will be 100%, this will be 100%, right? So eventually you will owe the tax the same amount, but you are deferring it, right? Right now, you are keeping more money as your profit, right? That's the idea of deferred taxes, okay? And that amount was $800,000, right? So you have to add it back, okay? And then, here's another item here, depreciation. You are adding $10 million depreciation back to EAT, right? Why? Because even though you subtracted $10 million here in the income statement as a depreciation, right? That did not really happen, right? This year anyway. It's only recorded figure in the book. The actual cash payment of $10 million did not occur, right? So you have to add it back. So here we have to focus on two items, okay? Deferred taxes of $0.8 million and depreciation of $10 million, right? So when you add them back, right, you come up with $22.8 million cash flow. And this figure should be compared to this $12 million, right? According to income statement, the bottom line, the net profit was $12 million, right? But actual cash flow was $22.8 million, much larger than that, right? The company is left with, after paying all the bills, right? Company is left with $22.8 million cash. Okay? Does it make sense? Okay. And trying to lower the temperature. I lowered it to 22 degrees. Let's see what happens. Weather changes quickly, huh? All right, any question about ATCF? After-tax cash flow, okay? So that's the beginning of our cash flow analysis. All right, let's go on just maybe a couple more slides, okay, today. All right, the statement of cash flows. We need to understand. This is what I told you about. This we're going to talk about it in this chapter. Right? We talked about income statement and balance sheet so far, right? But this is a third major financial statement, statement of cash flows. Okay? And there are, I think AC is working, right? Yeah. There are two different methods, direct method versus indirect method. Okay? And direct method is what FASB, F-A-S-B, I think it's called Financial Accounting Standard Board. Okay? Financial Accounting Standard Board. This is an organization that establishes all the rules in accounting in the United States. Okay? So FASB comes up with the GAAP, generally accepted accounting principles. Okay? Generally accepted accounting principles. Okay? So according to FASB, this direct method is recommended. Okay? But in practice, a lot of companies use indirect method because indirect method has some advantages. Okay? And we'll see the difference. Okay? So there are three components in direct method in cash flow statement. Cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. Okay? And here's an example. So you start with the first part is operating activities. Second part is investment activities. The last part is financing activities. Okay? First part, we're talking about the production and selling operation. Okay? So by producing and selling your service or products, you have received $142 million okay, from your customers. Okay? And then out of that, you paid about $120 million to your suppliers and employees. Those are expenses, right? And then you received some interest. Okay? Well, the companies actually invest in other companies as well, right? So many companies hold bonds of other companies, right? So they receive interest payments, okay, from those debt instruments. Okay? So in this case, it was $600,000. Okay? But then they also paid some interest, about $2 million interest payments probably on the bonds they issued. Okay? And finally, income tax paid. They paid $6 million income tax. Okay? So when you add them up, these numbers are negative. The numbers inside parentheses means negative, right? So when you add them up, you come up with a $14.6 million net cash provided from operating activities. Okay? All right? Then the next section is investing activities. Investing activities typically means purchasing and selling assets. Okay? So proceeds from sale of asset. Maybe they had some equipments that they didn't need anymore, or they might have sold some land they were holding, right? So they received $1 million cash by selling the asset, right? And then there was some capital expenditures. Okay? Again, here's a negative number. They spent $19 million in capital expenditure. What do you mean by capital expenditure? Any idea? Capital expenditure? Mostly, in other words, what they mean is just the purchased assets, right? Maybe purchase the equipment, or they built another plant or something, right? Or so they spent $19 million purchasing assets, right? So the investment activities, when you add them up, you come up with the $18 million negative, right? So this year, apparently, they had some major, I don't know whether it's major, but at least the expenditure exceeded income from investing activities, right? Then the last item, the financing activities, okay? This is what we call balancing item. Oops. Balancing item. We already talked about one balancing item when we were dealing with the balance sheet. Balancing item in balance sheet, right? In the balance sheet, we had assets and liability plus equity, right? Whatever you had here, right? These last two figures must be equal, right? So if you had assets here and liabilities here, whatever the difference between assets and liabilities are, right? This equity, the equity of stockholders, right, must make up for the difference, right? This is what we call balancing item. This is the item that balances two sides, right? The same idea here, right? This company received certain money, but apparently this year they spent more than what they received, right? Then that difference has to be made up by financing activities, right? That's the idea. And after all, what we mean by financing activities is borrowing, paying the debt, proceeds from issuance of long-term debt, proceeds from issuance of common stock, right? So this is probably the most area where the financial managers are involved, right? The first area, the operation, if you have vice president, several vice president, right? This area is under the control of vice president for operation, VP of operation, right? And the second area is maybe the vice president of whatever, the handling the asset purchase and sales. Okay, but this area is entirely the task of financial manager, VP for finance, right? Because whatever the money the company needs, right, the financial manager has to come up with, either borrow from the bank or issue the debt bonds or issue the stock, right? Somehow, the financial manager has to come up with enough cash to handle or allow this operation activities and investing activities, right? So according to this table, the story is, well, the line of credit agreement, which is usually just something like credit card, right? For a company. Company has some line of credit with the bank, right? And whenever they need, they can use this money, right? And they can pay back. And that if you have $1 million line of credit, right? If you use $500,000, you have $500,000 credit left, right? And you pay back that $500,000, then the line of credit goes back up to $1 million, right? So quickly, without really negotiating with the bank, you can use the money anytime, just like your credit card, right? That's the line of credit agreement, right? So here, the company borrowed $1 million. Whatever number you see here, if it's positive, that means cash inflow, right? If it's negative, it's cash outflow, right? So in terms of borrowing, positive number means you have borrowed, right? Money came into your pocket, right? Negative number means you paid back, right? Money came out of your pocket, right? So you borrowed $1 million, but you paid the long-term debt, $2.6 million long-term debt, right? So that's negative. And then you issued $4 million long-term debt, which is bond, right? And you issued $1.7 million worth of common stock, right? Debt financing, equity financing, right? And then finally, dividends. You paid about $500,000 dividend, right? So out of all that activities, you came up with $3.6 million positive balance, right? If you calculate this one plus this, you will come up with about $3.4 million, right? So out of operating activities and investment activities, the company was short of cash by about $3.4 million, which had to be made up by financing activities, right? But in fact, financial manager did a good job. Financial manager raised $3.6 million instead of $3.4 million, right? So the difference, $200,000, is added to the initial balance of cash, right? The initial balance of cash was $5 million, and that's probably target level of cash. Most of the companies have target level of cash, right? They want to retain at least some amount of cash just in case, right? It's a safety buffer, right? So in the beginning of the year, the company was holding $5 million cash, right? And this year, they ended up adding $200,000. So at the end of the year, they end up with $5.2 million cash, right? All right, this is a direct method of cash flow statement, okay? And we're going to continue on Tuesday with the indirect method. Any question? And last class we talked about direct method of the financial statement, which is recommended by FASB, Financial Accounting Standard Board. Okay? Now, indirect method involves adjusting the net income to reconcile it to the net cash flow from operating activities. Okay? And here's an example of indirect financial statement or cash flow statement. Okay? So it starts from net earnings, okay, which is an accounting figure, accounting income. Okay? So net earning or net income plus any non-cash expenses. Because as you know, this income, net income is actually the bottom line in what statement? Net income is the bottom line, the last line in what statement? What kind of financial statement? Trying to get you into the class, start thinking now, right? Okay. Income statement, right? Income statement. Income statement starts from net sales, okay? And then subtract all the expenses, and the bottom line is net income, right? But some of those expenses that have been subtracted, okay, are non-cash expenses, right? What are those examples? What are the examples of non-cash expenses? Depreciation, okay. And deferred taxes. Right? Yeah, we talked about these two items, I think, in previous class. Okay. All right. So that's what we are doing here. From net incomes that we find out from the income statement, we're trying to add non-cash expenses, and then we're trying to come up with the actual cash flow. Cash flow. So it's what we call reconciliation. Okay. We're trying to reconcile the difference between net income and cash flow. Okay. If you look at all these items, I'm not going to go through the whole details here. Okay. But you may see something like here, amortization. Okay. If you haven't taken any accounting class, this is something new. What's amortization, right? Amortization is a very similar concept to depreciation. Okay? This is a recovery of cost over multiple periods. Okay. So it's the same thing as a depreciation, actually. Depreciation is recovery of cost over multiple periods. Okay. So what's the difference between the depreciation and amortization? Okay. Depreciation is in case you purchase some equipment, plant, or something like that, some invested in facility, or you spend money in facility, right? Then instead of deducting the entire full cost in the first year, you recover those costs over multiple periods. Okay? Amortization is very similar concept, but instead of spending money in those equipments or facilities, right? Suppose you spend money in certain project. Okay? So in order to upgrade your labor force, you spend a lot of money to retrain your workforce. Okay? And it costs you $10 million. Okay? To retrain your workforce or upgrade their skills. Okay? Then instead of subtracting entire $10 million in the first year, you spread the cost over multiple periods. So it's the same thing. And again, it's a recovery of cost over multiple periods, but instead of equipment or tools or facility, it's something like project cost. Okay? So recover the full cost of a project over multiple periods. Okay? So that here, in this number, it's a $7.853 million. Okay? And it is positive. What does that mean? This is a cash flow statement, right? And if any number is positive, what did I say? What does that mean? Is it a cash inflow or outflow? Money coming into your pocket or going out of your pocket? Or your account? Is that a pocket? Right? Huh? Inflow or outflow? Inflow, yes. Right, it's an inflow. So you are adding this money back to net income, right? Because in the income statement previously, in order to arrive to the net income, you have subtracted apparently this amount, okay, from the gross sales and net sales. You subtracted this amount, okay, to arrive to this net income in the income statement, right? So in order to come up with the actual cash amount, cash balance, right, you need to add it back because this money has not been spent this year. Does it make sense? Okay, all right. So it's a very similar concept to depreciation. Just another thing that I want to get your attention to is here, deferred income taxes. That is negative $4.678 million, right? Here, deferred income taxes, right? Negative $4.68 million, okay? Well, you know what it is, okay? That's the amount of taxes that had been subtracted on the income statement to arrive to the net income, right? But you did not pay those taxes actually. That's the difference in the amount of taxes as a result of two different accounting standards or two different depreciation methods, right? Typically when you report it to your stockholders, right, you use straight line method, so net income tends to be smaller, tax liability becomes larger, right? But if you use MACRS, right, accelerated this depreciation, right, then you can reduce your tax liability, right? So this amount, typically deferred taxes in the previous example. All right, let me pull up here, okay? Here, deferred taxes was $0.8 million, okay? That was the amount that we added back to the net income in order to arrive to the cash flow, right? But here, in this example, in this particular example of gas company, right? And the deferred tax is negative. What does that mean? So just wanted to point out, right? So it can happen. So if it's negative, that means cash outflow, okay? And that means this particular year, the actual tax payment was greater than what you have deducted from the income statement. So that's still the difference between the actual tax payments and the tax payments recorded in the income statement. But apparently this year, the actual cash tax payment was greater, right? So when you consider the deferred tax payment, right, you are going to subtract it from the net income. How could that happen? Any idea? Your actual tax payment is greater than no?
They pay their head.
Pay their hat?
Pay ahead.
Ahead. Why would you pay your taxes ahead?
The deferred taxes should be paid later.
Later, okay. Right. So, yeah, I guess I didn't explain the whole thing in the previous class, okay? Let me, I guess, explain it, the concept here. You know what MACRS is? The accelerated depreciation, right? And I told you a lot of companies use MACR, accelerated depreciation. Okay? The reason is a company can continue to defer payments of taxes or tax payments as long as it continues to purchase new fixed assets. You continue to purchase new fixed assets. Okay? And let me just give you a very simple hypothetical example here. Okay? Suppose you purchase a computer. A computer is typically 5-year equipment. Okay? So companies are allowed to deduct it over 5 years. Okay? And that means if it's a $100 computer, right? You can deduct $20 every year for 5 years if you use straight line method, right? That's a straight line method. Okay? But let's say MACRS, accelerated method, allows you to deduct 60, 30, 10, 0, 0. Okay? So you subtract or you deduct larger portion of the value in the early year, okay? And then that means in the later years you cannot deduct any. Okay? So that's the idea of the difference here will create the amount of deferred taxes. Okay? And now, of course, starting from the third year, compared to the straight line method, your deduction will be lower. Okay? And that means your net income will be larger. You're deducting smaller amount of taxes, right? And so your tax liability will be larger. And in the next 2 years, there is no deduction. So you have to make up for all the tax benefit you enjoyed in the early years. Okay? That's the idea of deferred taxes. Okay? But what a company can do is about this time, they can buy another computer. Okay? So let's say computer number 2, right? And if they use straight line method, of course, the deduction can go like that. Okay? But if they use MACRS, then you can deduct 60, 30, 10, 0, 0. Okay? So what happens here? You can still enjoy larger deduction starting from third year. I mean, compared to the straight line method, if you were on straight line method, you could deduct $40 from your earning, right? But here, as depreciation, you can deduct 70, right? So this is an example of this concept, right? A company can continue to defer taxes as long as they continue to purchase new equipment, okay, if they use MACRS. Okay? But what happens if you don't purchase new equipment anymore? Then your tax liability will be larger compared to the straight line method. Okay, so it will be reversed, right? The difference between actual tax payments and the tax payments reported in the income statement, right? In the first years, your actual tax payments will be smaller, right? And you can do that as long as you continue to purchase new equipment, right? But for some reason, you stop purchasing new equipment, right? Then the tax liability will be reversed, okay, compared to the straight line method. Okay? So my guess is that's what happened with the, okay, here. This year, gas companies' deferred income taxes, the actual cash payment was larger than the deduction on the income statement, right? So they ended up subtracting that amount from the income statement in order to arrive to the actual cash flow. Okay. Other items, why don't you go through yourself? And if there is any question, let me know. Okay. But the idea is, again, this indirect method is reconciliation of net income, net earning, and the final cash flow at the end, right? So bottom line here is cash and equivalents at end of period. Okay?